Watching the Indian small cap market over the last few years has been, well, it's a bit like watching a marathon runner.
Oh, absolutely. A very ambitious one.
Right. Like a runner who suddenly decides to just, sprint the first 10 miles of the race at an absolute world record pace.
Yeah, which completely defies all conventional logic.
Exactly.
Right.
I mean, it is thrilling to watch, but in the back of your mind, you just have this creeping feeling
Yeah.
that eventually they are going to have to slow down. Like the human body just can't sustain that.
That is a very apt way to look at it, actually. Financial markets, much like that runner, have absolute limits when it comes to momentum.
Right? They can't just go up forever.
No, they inevitably have to revert to some kind of sustainable baseline, because if they don't, the whole system just overheats.
And that reality, that brings us directly to our mission for today's deep dive. Because we are figuring out if that marathon runner has finally caught their breath and is, well, about to start sprinting again.
Which is the big question everyone is asking right now.
It is. Specifically, we want to know, are you sitting there as an investor, standing on the edge of a massive new financial upcycle for Indian small cap stocks?
And to figure this out, we are drawing on a highly detailed piece of source material today.
Yeah, we've got an August 2026 newsletter from Ambit Asset Management. It's titled A New Ascent for Small Caps.
That's a great report. Lots of really deep data in there.
It is.
Yeah.
So, okay, let's unpack this because the numbers in this report are just a wild ride.
They really are.
I mean, we're looking at a market segment that skyrocketed 48.1% in 2023.
Huge jump.
Right. Then it jumped another 26.4% in 2024. But then suddenly it slumped, declining 6% in 2025.
Which, is a textbook example of market volatility. But we really need to set the overarching theme here before we get lost in the percentages.
Okay, let's do it. What's the big picture?
Well, small caps are inherently cyclical creatures. If you look at the historical data over the last 15 years, major sustained outperformance in this segment almost always follows prolonged periods of correction and consolidation.
So the dips are kind of a prerequisite for the jumps.
Exactly. So the central question we need to answer for you today is whether the stars, meaning geopolitics, corporate earnings, valuations, and domestic money, are aligning right now for a major rebound.
I see where you're going with that.
Yeah.
But before we can confidently predict any kind of rebound, I feel like we need to logically understand why the market actually dropped in 2025 in the first place.
Right. The diagnosis is crucial here.
Because was it a structural catastrophe? Or, going back to our marathon runner, did the market just need to stop and catch its breath?
Yeah, that's the key distinction.
Essentially, was it a runner catching their breath or a runner breaking their leg?
Well, the data points strongly to the runner just catching their breath, which raises an important question about the nature of market crashes in general.
How so?
Because not all dips are created equal, If we contrast the 2025 decline with previous major corrections, the differences are incredibly stark.
Give me an example.
Well, think back to 2018 and the ILNFS crisis. That was a true structural breakdown.
Wait, let's pause there for a second. When you say structural breakdown for 2018, what actually broke under the hood?
That's a fair point to clarify because to a lot of people, a crash is just a crash.
Exactly. The lines on the graph just go down.
Right. But in 2018, the actual mechanics of lending broke down. ILNFS was this massive infrastructure finance company that defaulted, which triggered a huge panic in the shadow banking sector.
Oh, right. So credit literally dried up overnight.
Exactly.
Yeah.
So if you were a small, fundamentally solid manufacturing business, it didn't matter how good your product was. You suddenly couldn't get the short-term working capital you needed just to make payroll or buy raw materials.
The financial plumbing was basically blocked.
Yes, perfectly said. Or, look at 2020. That was a massive, unprecedented external pandemic shock where the global economy just turned off.
Right. Factories closed. Ships literally stopped moving.
Yes. But the 2025 decline was entirely different from both of those scenarios. The financial plumbing was fine. The factories were completely open.
So what was it then?
2025 was purely a valuation reset.
A valuation reset, meaning like the actual businesses were still selling products and making money, but the stock prices had just gotten wildly detached from reality.
That captures it perfectly. Corporate earnings were actually still growing, but investor expectations had reached an absolute fever pitch after those massive runs in 23 and 24.
Because everyone just assumed the good times would roll forever.
Right. The market had priced in perfection. Investors were assuming these companies would double their profits every single year forever. which is impossible.
Right, obviously.
So when earnings growth naturally moderated just a little bit from those exceptionally strong levels, the valuations just had to come back down to earth.
The engine of the economy wasn't broken. It was just running way too hot and needed to cool
I
off.
think
And looking at the Ambit newsletter, that cooling off has created a really interesting landscape right now.
it definitely has.
There's a stat on page 4 that really jumped out at me. As of July 2026, 47% of small cap stocks are now trading below their 10-year average valuations.
That is a massive chunk of the market.
It's almost half the entire market on discount. And compare that to large caps, where only 27% are trading below their historical averages.
It really highlights the disparity.
Yeah. So if you were looking for value right now, the small cap universe is essentially offering a much broader, much deeper bargain bin than the big recognizable names in the Nifty 50.
It represents a profound shift in the risk-reward balance for anyone analyzing this space. All that speculative excess from the previous 2 years has basically just been washed out of the system.
Okay, so we've diagnosed the 2025 dip. We know the internal engine of the market is fine. It just let out some steam.
Right.
But, a cheap stock can stay cheap forever if nothing actually changes. What external sparks are igniting this current recovery?
That's where we have to look outside of India.
Exactly. Let's move from internal market mechanics to the global macroeconomic stage, because the shifts happening out there right now are massive.
They really are.
First off, there's a huge geopolitical pivot. The source highlights the massive economic relief from the recent June 2026 United States and Iran ceasefire framework.
Which is something you really can't understate when talking about the Indian economy.
Because the oil, right?
Yes. We import the vast majority of our oil. It's the lifeblood of the industrial sector.
Exactly. And you can see the hard data responding instantly to that ceasefire. Brent crude oil dropped from a peak of $115 a barrel down to around 82.
That is a huge relief for profit margins across the board.
And furthermore, the Indian rupee, which had been really sweating under the pressure and weakened to nearly 97 against the US dollar, it finally stabilized back to 95.7.
Right, because cheaper oil means cheaper freight, cheaper raw materials, and ultimately less inflation.
But beyond just the oil, there is the trade data, which frankly is just staggering.
You're talking about the tariffs situation?
Yes, the tariffs. India went from facing a highly punitive 50% U.S. tariff in August of 2025 down to an interim 18% in February 2026.
And it kept going down.
Yeah. As of this report in July 2026, it sits at a highly competitive 10%.
That is a massive structural shift.
It is. But here is my pushback to you on this. Obviously, lower tariffs are great for the country as a whole. But why does an 8 or 40% drop in tariffs matter so much more for these smaller, scrappy, small-cap companies than for the giant multinational conglomerates?
That's a great question. What's fascinating here is the underlying mechanics of something called operating leverage combined with pricing power.
Okay, let's break that down.
So large cap companies usually have very dominant market positions and much wider profit margins. If a tariff hits them, they can often absorb some of the costs.
Or they just raise prices, right?
Exactly. They have the brand power to just pass that cost directly on to the consumer. Small caps simply don't have that luxury.
Right, because they are usually in much more crowded markets.
Yeah, they operate in highly fragmented markets on razor-thin margins.
So they are basically fighting for every single penny.
Yes, exactly. So let's look at the operating leverage part. Imagine a small cap company where, after paying for all their fixed costs like factory rent and machinery, they only make a 5% net profit margin on what they export.
Okay, 5%. Pretty tight.
Very tight. Now, if their export costs suddenly drop because a 50% tariff is slashed to 10%, that massive reduction in their variable cost goes almost entirely straight to their bottom line.
Oh, wow.
Because their margins were so thin to begin with, a drop in tariffs doesn't just increase their profit by a few percentage points. It could literally double or triple their net profit overnight.
That is wild.
It is fundamentally life-changing for their profitability.
That makes total sense. It's like the difference between just barely treading water and suddenly having the cash to go build a speedboat.
That's a great analogy. And look at the competitive landscape that tariff drop creates on a global scale.
Right. Because we aren't just competing with ourselves.
Exactly. With that 10% tariff, India is suddenly beating major regional manufacturing competitors like China and Vietnam.
Where are they sitting right now?
They're both currently sitting at 12.5%. So the playing field hasn't just leveled, it has actually tilted in India's favor.
Wow.
Furthermore, when we connect this to the bigger picture and look ahead, the upcoming free trade agreements, the FTAs with the US, the European Union, and the UK, are projected to boost India's annual exports by roughly $67 billion starting in 2027.
$67 billion.
Okay.
That is a colossal injection of capital into the manufacturing ecosystem.
It's transformative.
And the newsletter specifically points out that certain small cap sectors, like capital goods and chemicals, are disproportionately positioned to win here.
Yeah, because they have a much higher export intensity than the broader market index.
So the global macroeconomic winds are definitively blowing in their favor right now.
They certainly are. But, as any seasoned investor will tell you, favorable global winds are entirely useless if the companies themselves aren't actually executing on the ground.
Good point. A nice breeze doesn't help if your boat has a hole in it.
Right. We have to look past the macro environment and open up the engine room of these actual businesses.
Let's do that. Let's look at the actual earnings and valuations, because here's where it gets really interesting and honestly a bit confusing to me.
Okay, what's standing out to you?
Well, despite all the stock market volatility and the price drops of 2025, the underlying businesses were crushing it. The nifty small cap 250 saw an estimated 27% year-over-year increase in profit after tax pad as of June 2026.
That is a phenomenal growth rate for a broad index.
It is. The companies are objectively making significantly more money. But reading through this data, I have to point out a glaring contradiction.
Let's hear it.
Hold on, I'm looking at this chart on sector performance, and something just isn't clicking.
Okay.
The market segment overall goes down 6% in 2025, but their overall profits go UP by 27%.
Yeah.
In a rational world, stock prices track earnings, right?
In theory, yes. In the long run.
Right. And even stranger, if earnings expectations are so fundamentally stable, why is the market reacting so inconsistently across different sectors?
Let's hear the specifics. What are you seeing in the sector breakdown?
Well, the data shows sectors like IT and realty are still among the absolute weakest performers over the last 12 months in terms of their stock price.
Right, they've been lagging.
But meanwhile, sectors like banks and capital goods are seeing astronomical returns. Like banks are up 102% over the last year.
It's a huge divergence.
Yeah. If this rising tide of 27% earnings growth is supposed to be lifting all boats, why are some boats basically sinking while others are strapped to rocket ships?
That is a brilliant observation, and it really gets to the psychology of investing. It comes down to a mechanism we call the lag effect in financial markets.
Well, lag effect. Okay.
Remember our earlier point. The 2025 correction was driven by a valuation derating, not fundamentally broken business models.
Right, the runner just catching their breath.
Exactly that. So what happens in these scenarios is that investor sentiment gets badly bruised. Investors feel burned.
Nobody likes losing money.
Obviously not. So even when a sector like information technology or consumer discretionary continues to show really stable, solid earnings growth on paper, the human beings buying the stocks remain skeptical.
The gun shy.
Exactly. The valuation recovery, meaning the willingness of investors to pay a premium multiple for that stock, actually lags behind the factual mathematical improvements in the business's fundamentals.
Okay, so the market is holding a grudge, basically. Yeah, like the company's out there saying, look, we made 20% more money this quarter. And the market is just standing there with its arms crossed saying, yeah, but you hurt my feelings last year, so I'm not buying.
That is a very human way to put it, but yes, essentially. And this lag effect is exactly what creates a highly specific pocket of opportunity for anyone willing to look closer.
How so?
Well, sectors like banks have already been re-rated. The crowd has recognized the value, the grudge is gone, hence the 102% return.
Got it. So that ship has basically sailed.
For the most part, yes. But if you look at discounted sectors with stable, above-median growth like internet companies or consumer discretionary, they are still traded way below their 10-year historical averages.
So the fundamentals of those businesses have improved, but the stock price just hasn't caught up yet.
Exactly. The gap between performance and price is the opportunity.
Okay, so what does this all mean for the overall architecture of the market right now? We've established we have cheap companies, we have excellent global macro conditions with falling oil and tariffs.
Right. And we have rising corporate profits. But, let's be real, none of that matters if there's no fuel in the tank to drive the next cycle.
It's all just theoretical without liquidity.
Exactly. Who is actually buying these stocks, and how are these companies paying for their future growth? Let's talk about corporate health and liquidity.
This might actually be the most crucial piece of the entire puzzle. It's the foundation everything else is built on.
Well, the numbers in the Ambit report are incredibly strong on this front. Corporate profit to GDP hit an all-time high of 7.9% in the 2025 financial year, and that includes the unlisted universe.
That's a huge milestone.
It is. Furthermore, net debt-to-equity ratios across the small-cap segment are sitting at multi-year lows.
They've deleveraged significantly.
Right. It actually reminds me of a family that spent an entire decade painstakingly paying off high-interest credit card debt.
Oh, that's a good way to frame it. Yeah, so now they are completely debt-free, and their monthly income is higher than it has ever been. So every new dollar they earn doesn't have to be sent to the bank to pay off interest.
Right. It can be reinvested.
Exactly. You can go straight into building a brand new extension on their house.
And that new extension, in corporate terms, is capital expenditure, or CapEx. Building new factories, upgrading software, hiring more research teams.
Building the future, basically.
Exactly. And the data reflects your family analogy perfectly. Private CapEx, excluding Reliance Industries, grew an impressive 16% year-on-year in FY26.
Wow, 16%.
Yeah. When companies have record profits and remarkably low debt, they reinvest in themselves. They expand their capacity to produce more.
Makes sense.
And if we look historically, sustained private sector CapEx cycles are the ultimate catalyst for small cap outperformance.
Why is that specifically true for small caps, though? Like, why not just buy the giant companies doing the building?
Because small caps are deeply wired into the domestic industrial ecosystem. When a massive large cap infrastructure company decides to build a new bridge or factory, they don't do all the work themselves.
Oh, they outsource it.
Exactly. They hire hundreds of smaller, specialized companies, the small caps, to provide the steel, the specialty chemicals, the logistics, the engineering consulting.
The small caps are the cogs that make the big machine run.
That's exactly it.
Okay, so the companies are fundamentally healthy, and they are funding their own growth with cash, not debt. But we still need to talk about the stock buyers. Who is actually buying their stock?
This is a major paradigm shift.
It is, because this is where the newsletter highlights a tectonic shift in the Indian financial landscape. It used to be that foreign institutional investors, the big global funds, dictated the entire mood of the Indian market.
For a very long time, yes.
Right, like if foreign money got spooked and left, the market crashed, period. But that narrative has completely flipped.
It really is the most profound structural shift we've seen in the Indian markets in a generation. The rise and now the absolute dominance of the domestic retail investor.
Everyday people.
Exactly. And this fundamentally changes the entire volatility profile of small cap stocks.
The statistics on this are just mind-blowing. The report notes that net inflows into small cap mutual funds quintupled over just 4 years.
A massive acceleration.
I mean, we are talking about going from roughly 10,145 crore rupees in FY22 to a staggering 51,872 crore rupees in FY26.
Let's unpack the mechanics of why that matters so much, beyond just the raw numbers.
Sure, why is it so different?
Because that domestic money isn't just a lump sum that jumps in and out. It is incredibly sticky. It is driven by systematic investment plans, SIPs, from everyday retail investors.
Right. And, for anyone not familiar, an SIP means automated deductions. It means every single month, a portion of someone's paycheck is automatically routed into a mutual fund, regardless of what the stock market is doing that day.
Precisely. It creates what analysts call a technical tailwind.
Okay, let's translate that into plain English.
Right. So in the past, if a global event happened and foreign funds panicked, they would dump millions of shares on the market.
And with no buyers, the price would just plummet.
Exactly. But today, those monthly automated SIPs act as a giant price-agnostic sponge. When foreign investors sell, the domestic SIP machine just blindly buys up those shares.
Absorbs the shock.
It really does. Historically, small caps lacked this. They were entirely at the mercy of hot foreign money flowing in and out. Now they have a solid bedrock of domestic liquidity that stabilizes the market depth.
That makes it a much more mature, resilient market.
Absolutely.
And the source actually ties all these macro themes into how Ambit designs its specific investment portfolios. They aren't just blindly buying an index of every small cap out there.
No, that would be too risky.
Right. They are applying a very strict filter to this universe. They are actively looking for companies with exactly what we just discussed. high return on capital meaning businesses that are incredibly efficient at turning a dollar of investment into a dollar of profit.
Alongside extremely low debt and impeccably clean accounting,
Right.
that filtering process is essential in small caps, where, let's be honest, corporate governance can sometimes be a bit of a minefield.
Yeah, you have to be careful. They actually mentioned their emerging giants portfolio, which targets small caps that already dominate their specific niches.
Right.
And they also mentioned their micro marvel strategy, which focuses on high growth, low leverage micro caps.
They are actively hunting for the exact companies we talked about earlier.
The ones building those house extensions with cash they earned, not with debt they borrowed.
Exactly. They are utilizing a process-oriented approach to filter out the noise and capture the companies that actually possess the structural, fundamental advantages required to ride this incoming wave.
It's about finding the highest quality engines in a market that is broadly getting cheaper.
Exactly right.
So bringing it all together for you, the listener. The journey we've tracked today paints a really compelling, multifaceted picture.
It really does.
The external geopolitical risks that panicked the market have faded, with oil prices dropping and the rupee stabilizing.
Which is huge.
Right. And punitive tariffs have plummeted, suddenly opening up highly profitable global trade routes. Inside the engine room, earnings are up a staggering 27%. Yet valuations have cleanly reset to historical averages.
The fundamentals are incredibly strong.
They are. Corporate balance sheets are flush with cash and light on debt. And perhaps most importantly, a massive automated tidal wave of domestic retail money is flooding the zone, providing unprecedented stability.
The pieces are definitely in place.
Yeah. The mission of our deep dive today was to figure out if we are on the edge of a new upcycle. And honestly, the anatomy of that potential upcycle is incredibly clear.
It is. Because successful investing is ultimately about recognizing patterns before they become obvious to the broader crowd.
Right.
And right now, the specific historical conditions that have reliably birthed massive small cap upcycles over the last 15 years are clearly reemerging. The business fundamentals have simply caught up to the stock valuations.
But as always on this show, we want you to keep questioning the consensus.
Always.
We've talked a lot today about that powerful bedrock of domestic liquidity, the SIP machine. But I want to leave you with a final lingering thought to mull over on your own.
Okay, let's hear it.
If this historically volatile small cap market is now being propped up primarily by everyday domestic retail investors rather than massive foreign institutions, what happens to the stability of this market if local economic sentiment suddenly shifts?
Oh, that's a tough one.
Right. If domestic job security wobbles, or local inflation spikes and families need that cash for groceries, do those monthly automated SIPs suddenly get turned off?
It's a very real possibility.
Are these domestic investors truly a permanent bedrock? Or are they just fair-weather friends who haven't yet been tested by a true domestic recession?
That really is the multi-billion-dollar question, isn't it?
It is the ultimate stress test. It looks like our marathon runner has definitely caught their breath. Their heart rate is down, their muscles are rested, and the road ahead looks clear.
But we won't know for sure how strong they are until the starting gun fires again.
Exactly. Thank you for joining us on this deep dive. Keep questioning the data, keep looking for the underlying mechanisms behind the headlines, and we will see you next time.